what is brought to us, and by action, you receive it. Friends, with this, we begin today's seminar. Hello, everyone, and welcome to today's session. It gives me immense pleasure to extend a very warm welcome to you on behalf of Bhayander CP Study Circle. Friends, it's our 7th VCM for financial year 21-22. And our today's topic is issues in direct taxes. For today's session, we have a very learned speaker, CA Piyush Chhajed sir with us to explain the topic to our members. Friends, we acknowledge the presence of our guest speaker, Sheetal sir, RCM WIRC, and our branch nominee, CA Vimalji Agarwal, who is also RCM. I request Vimalji to please say a few words. Vimalji, over to you.
Thank you, Ritu. Good morning, everyone. Hope all of you and your family members are safe and fine. First of all, I welcome my colleague and treasurer in WIRC, CA Jayesh, our today's speaker, CA Piyush Chhajed. I congratulate Bhayander CP Study Circle for organizing this conference on topic issues in direct taxes, in which our today's speaker, CA Piyush Chhajed, tell us two issues in direct taxes and solution of that issues. To organize this conference, Bhayander CP Study Circle team, Convenor CA Ritu Agarwal, Deputy Convenor CA Sheetal Sharma, Vasai Branch Past Chairman CA Nitesh Kothari, Vasai Branch Committee Member CA Amit Agarwal, Immediate Past Convenor CA Nikunj Bangaria, Past Convenor CA Sandeep Jain, Study Circle team member CA Kishore Mehta, CA Akash Agarwal, and other team member of Study Circle had done very good job. Bhayander CP Study Circle is always try to do very good work for the benefit of our members, students, and society at large. In this pandemic time also, they are doing very good job. मैं जब भी मेरा व्हाट्सएप चेक करता हूं तो देखता हूं कि कोई ना कोई नया प्रोग्राम भयंदर सीपी स्टडी सर्कल ने ऑर्गेनाइज किया है. इसके लिए मैं पूरी टीम को बधाई देना चाहूंगा. फ्रेंड्स, this year I am heading MCS coordination committee of WIRC. Objective of this committee to equip the CA students to the profession with some essential skills such as sharpen communication and presentation skills, to develop interpersonal and leadership skills, to prepare the students for a career either in employment or in practice by educating them to adaptable and accountable. WIRC has taken various initiatives for the benefit of our members, like back-to-back Power Pact seminar by expert faculties, launch various useful publications for members and students. Friends, मैं भयंदर सीपी स्टडी सर्कल की टीम को बोलना चाहूँगा कि स्टडी सर्कल को WIRC से जो भी सपोर्ट जब कभी भी रिक्वायर होगा, मैं उसके लिए हमेशा रेडी रहूँगा और मेरा 100% कोशिश स्टडी सर्कल के बेनिफिट के लिए रहेगी. थैंक यू एवरीवन, बी सेफ, टेक केयर.
Thank you so much for sharing your vision, and thank you so much for your support. With this, I request dynamic regional council member WIRC CA Jayesh to share his thoughts. Sir, over to you.
Thank you, Ritu ji. Thank you very much. विमल जी ने अभी काफी ब्रीफ में although in brief, but he told a lot about the Bhayander CP Study Circle and also about the activities being undertaken at WIRC. Today's speaker, Piyush Bhai, is very renowned and I can say he's an authority in direct tax. मुझे आज भी याद है, मैं इनकम टैक्स में जब हियरिंग के लिए जाता था, अभी तो नाउ तो इट इज फेसलेस, बट व्हेन आई यूज्ड टू गो टू हियरिंग, पर्सनल हियरिंग विद द कमिश्नर और इक्विवेलेंट अथॉरिटी, तो मतलब आई रिमेम्बर वी हैड टेकन सम ओपिनियन फ्रॉम छाजेड एंड दोषी. तो व्हेन वी आर आर्ग्यूइंग द केस, तो ही टोल्ड दैट यू गिव अस सम सपोर्ट फॉर व्हाट यू आर सेइंग. Then I just told that, sir, we have taken opinion from a CA firm. So he told कि just अच्छा ठीक है, आप हमको opinion बताइए. हमने ओपिनियन दिया, द लेटर हेड वाज ऑफ छाजेड एंड दोषी, बस उतना देखने के बाद वो बोले कि नहीं नहीं नाउ ठीक है, इफ दे हैव गिवन ओपिनियन देन इट इज करेक्ट. सो दैट इज द goodwill brand what has been created by Chhajed and Doshi and Piyush Bhai at the helm of the affairs, heading the direct tax department, is really an authority. And today indeed the member of Bhayander CP study circle are fortunate that issues in direct tax will be discussed by respected Piyush Bhai Chhajed. I request study circle members to also take up the topic related to issues in website of direct tax, because now, just in a lighter tone, because now the it is understood that around 988 pages instructions have come. उसके लिए तो मुझे लगता है कि अपने को शायद 2-3 दिन का सेमिनार पूरा रखना पड़ेगा फॉर अंडरस्टैंडिंग दैट what are their terms and how it has to be cope up. But yes, there are challenges in income tax portal, but then definitely the department is looking after it. The finance ministry is looking after it. At WIRC we are taking a lot of initiatives. Some of the initiatives Vimal Bhai has already told. One of the initiatives what we have taken is we have started a mentorship program wherein the mentors and mentees can register themselves. If some of the chartered accountants, senior chartered accountants believe that yes, they have the required experience and they would like to train the mentee so that the efforts and the struggle what they have done during their practice tenure should be guided to the mentees, so that they should not go same type of struggle what they have did, so they can register themselves as a mentor. Similarly, chartered accountants who are fresh and who are new and who would like to have some guidance from the mentors, or some experienced chartered accountant who would like to change their area of practice, or who would like to further excel in their area of practice, like किसी को income tax में करना था but now he has to explore himself in audit or forensic audit, or if somebody was doing in income tax, now he wants to further elevate himself to the representation practice, then definitely they can register themselves as mentee. And there are experienced mentor available. Piyush Bhai is one of the mentors, so they can guide you. There are 2 types of program. All the details are available at WIRC website. Members can go through that and can take benefit of that. In the process of a mentorship program, I was well assisted by CA Shweta Jain from the Vasai branch, who has exceedingly done very well in taking up the set program and joining hands and structuring the entire program. So once again, I express my acknowledgement. I acknowledge my thanks to Bhayander CP Study Circle for inviting me and allowing me to interact with all the members over here. Thank you very much.
Thank you so much, sir, for your kind words. And thank you for all the informations you have given to our members. That will be really helpful, and your presence is certainly an encouragement for our members and our team. Thank you so much. With this, before moving to technical part of today's session, I request CA Sheetal Sharma, Deputy Convener, to quickly acquaint our today's speaker, Piyush Chhajed, sir.
As already and gist has been given by Jayesh Kala sir, it's an honor and privilege to acquaint our member with an elite speaker who has already enlightened on various topics of direct tax. He has an expertise and specialization in direct tax and indirect tax appellate proceeding and arbitrations proceedings. He is a member of RBI External Advisory Committee of Reserve Bank of India for Asset Restructuring Companies 2019 onwards. He is a member and co-opted members of various committees of ICAI and WIRC, to name a few: Central Council Committee of Strategic Perspective Planning and Monitoring Committee ICAI 2019-20, Revisions of Publication Guidance Note on Tax Audit under Section 44AB of Income Tax Act, co-opted members of CCM on government accounting and boards of studies, co-opted members at WIRC for direct tax committees, journal committees, career counseling, CP committees, etc. Sir has written various articles on the subject, some of being FAQs on charitable trust, Vivad Se Vishwas scheme, and WIRC publication on Finance Bill 2021. Not only professionally, but Sir is also active as socially, being independent director at Wimplus Cello Group, Honorary Vice President of Jain Chartered Accountants Federation JCAF Mumbai, Honorary Joint Treasurer of Shri Vijay Himachal Surji Kirti Stambh Ghanerao Rajasthan, Trustee of Shri Vardhaman Jain Govindpura Samiti Tirth Rajasthan, Trustee of Jayabhai Memorable Trust, Trustee to Shri Juhu Lane Jain Sangh. Indeed, a pleasure to have you, sir, here. Please guide us through the topic. Welcome, sir, to the Bhayander CP Study Circle.
Thank you very much, Sheetal, for your introduction. Thank you very much. Convenor of Bhayander CP Study Circle, Ritu Agarwal, Deputy Convenor Sheetal Sharma, past convenors Sandeep Jain, Amit Agarwal, Nikunj, the regional council members Jayesh Bhai, Vimal Agarwal. Very thankful for giving Jayesh Bhai for introducing me and speaking too high about me. We try to practice in direct tax, and our motto behind CNA has always been to do a legal practice, don't involve ourselves as far as possible in hanky-panky, and that remains our motto, and that is what we have been taught over a period of 56 years. And I was just and the esteemed members of other esteemed members of this study circle. I'm glad to know this is the 7th program of this study circle, and I think so we are only 60 or 70 days from after the start. I think so it starts from 1st April 21. So it shows the dynamism of the study circle. 7 study circle programs means 3 on an average a month is quite a good, and it's quite a good performance. Now coming to direct taxes, as obviously everybody is waiting for the new website. Jayesh Bhai did mention that you should also have a program on this new website and the new rules. I don't know what does it contains and what errors people will be facing. But I always wonder why this new site, new website has all come. What's the purpose? Is there anything going to be achieved? But I am also saddened by what will be happening is when the preliminary look, of course, I also have not looked at it, but what feedback I've got from my team is that you may have to re-log in everything. You may have to re-register your digital signatures. You may have to refill your profiles because your profile has not been properly migrated. And any migrations definitely have a problem. I've seen a very big migrations, and there is always a migration issues. I'm really deeply saddened on this because a lot of man hours will be going into this for nothing concrete which will come out of it. What according to me I feel is because registering, making your profile again, getting yourself registered, getting yourself is itself a good pain. If we achieve something out of that, and if we get good results out of that, I'm sure it would be worth doing it. But the way it seems today, it does not look to it. But I'm sure when the study program and the branch start doing more programs on it, we will get enlightened over it. Now the topic given to me is issues in direct tax. Direct tax is more or less settled according to me, everybody would feel, because 90% of our CA practitioners practice into direct taxes. So direct taxes is a routine thing. Every year we file a return of income, and still there shouldn't have been issues ideally in an ideal situations. But unfortunately, year on year, my experience has been, as and when the budget keeps on coming, the new Finance Act 2021 comes, then there are various ordinances, that is Finance Act 2020. So if you see last 4-5 years, whatever amendments have been made, there are a lot of issues keeps on cropping up it. And there are also still perennial issues. So the perennial issues continue. The assessing officer does not want to actually look into the judgments or the decisions which have come from Tribunal, High Court, Supreme Court, and he follows his own mentality. He keeps on making additions, and the issues keeps on continuing. Ideally, the certain issues are such which have been resolved by certain judgments which are technically binding on the assessing officer. Their judgment may not be of the apex court, but maybe of the jurisdictional high court or any other high court. and the assessing officer should follow. But unfortunately, it does not. He does not follow, and that leads to an issues by way of the assessment order, and that results into the litigations basically. Even if you see the amendments which have been made in last 3-4 years, there are always, with every amendment, my experience has been with every amendment that has been made in the Income Tax Act, there is always an issue. There is always an open area which can be debated either way, debated in the favor of the assessee, debated in the favor of the department, and therefore the issues in direct tax remains. This topic also becomes important from our practicing chartered accountants point of view, because most of our chartered accountants even today who are into traditional practice, the major 80 to 90% of our practicing CS actually depends upon their direct tax practice. Obviously GST practice has come up in last 2 years, 3 years, but that is related to compliance. Your more advisory role, the more advisory role of chartered accountants is looked into a direct tax, and therefore it becomes very important for us to know what are the issues in relation to amendments which have been made during last 3-4 years. With these issues, if it is registered in our mind, it becomes easier for the practitioner chartered accountant to advise appropriately to our clients. That is where we can give them a value addition. We can bring to their table. We can bring to them advisory which they are not doing. We can actually explore new ideas. We can actually give them the new ideas, new innovation ways, which actually fits in the law and which they may not be doing it. So with this background, I will start my presentation on issues in direct tax. Of course, I am covering the important issues because issues in direct tax are many. It can take if I am to select a one particular section, mind me, even one particular section, you can discuss it for more than 2 hours. If I want to take a small amendment which has been made in Finance Act, you can discuss it for 1.5 to 2 years. But what I've done is I've compiled a list of 15 to 20 issues, which includes the important issues which are latest, which have cropped up because of the amendments made by Finance Act 2021 or Finance Act 2020 or in last 2-3 years, and which are relevant even today. So I'll try to cover up those issues in detail, number one. Number two, while I'm covering an issues, obviously I'll give a background of the existing provisions, what the amendment has been made, and what could be the issues. Now, the certain issues are resolved by the prior judgments, decisions which are appearing, which we have, but certain issues will remain open. And during our practice, we will have to look into it. We'll have to take a view based on the whatever judicial precedents we have and advise our client accordingly. So this would be my manner of my presentation. Then there are certain perennial issues, so I will touch up quickly, and it will be forming part of my presentation. There are certain issues which are included in the presentation, but I will just quickly glance through it. And because the presentation will be circulated among the members, it will be benefited to them. So with this, I'll start my presentation. So on my screen, I've started my presentation now. So the major of a topic is issues in direct tax by the CPE study circle. So with this background which I've given, I would like to first address the very first issue is in regard to the goodwill provisions, which has been amended from Finance Act 2021. So as I mentioned, I will be concentrating first amendments on Finance Act 2021 and the issues which have arisen because of those amendments, and whether that can be resolved to a certain extent, and if it cannot resolve, then what are the open issues. So I'll try to summarize this position as far as. So when now starting with the very first point is the goodwill provisions. And goodwill and slum sale is the another amendment which has happened in this, and we are reading day in, day out newspapers that there is a lot of changes have been made in the slum sale, which will actually change the way in the business takeovers, mergers, and acquisitions are happening. Similarly, goodwill provisions also will make change. So both have to be looked together and then understand what would be an issue. What is the objective behind the amendment of goodwill, and what was the background of this goodwill? As you know, the goodwill we have an accounting standard 14, which deals with investments, amalgamations and mergers. What it says, at the time of merger and amalgamations, AS14 says, if any amount is paid by the transferor entity to a transferee in excess of the book value of the assets taken over at the time of the merger, that consideration should be recorded as a goodwill. So at the time of the mergers and acquisition, we had to follow an AS14 basically, and as per the AS14, you need to record it as a goodwill. Now the question arose for the purchaser, for the acquirer, how you should record this goodwill. So AS14 was recording as a goodwill, and the goodwill was when the assessees were arguing that goodwill is included in the definition of intangible assets. Though intangible assets existing definition does not speak of goodwill, but it talks of any other commercial or similar rights. So it says it first defines actually specific items, which are technical know-how, then there is patents, copyrights, and then it says any other commercial or similar rights. So based on that, assessee was used to argue that the goodwill is nothing but any other commercial or similar rights. This didn't go well with the department, and department was disputing it. The matter went up to the Supreme Court, and in 2012, the Smith Securities laid down the Honorable Apex Court in Smith Securities held that a goodwill will form part of the definition of intangible assets, and the depreciation is allowable, and accordingly a depreciation was calculated and allowed at 25%. So this is the behind the original history of this goodwill. What amendments have been made in the Goodwill Finance Act 2021? So section 211, which defines a block of assets. So it is a definition of the block of assets. Any assets which you want to claim depreciation should form part of block of assets. So there is a block of assets has been again divided into tangible assets, intangible assets. This section 211 has been amended to exclude goodwill out of the block of assets. Similar amendment has been made in section 32, which deals with depreciation, 32 bracket 1 bracket small 2 Roman 2, and explanation 3, wherein goodwill of the business of profession shall now not be considered as an intangible asset and shall not be eligible for depreciation. So as I said, the assessee were arguing that the definition of inclusive definition of intangible assets mentioned that any other commercial or similar rights. Now it has been amended to state any other commercial or similar rights excluding goodwill. So goodwill has been excluded. There is another adjustment amendment made in 50 bracket 2. 50 bracket 2 deals with the WDV. And it says that because any goodwill you were claiming a depreciation. Now this amendment is though passed by Finance Act 2021, which was passed on 28 March 21, but majority, lot of amendments are effective from financial year 2021. Technically, the Finance Act 2021 actually comes into the force for financial year 21-22, assessment year 22-23. But during this Finance Act 2021, a lot of amendments have been made which are applicable from assessment year 21-22, and it is relevant now because this year it will be applicable when I'm filing my returns in September, in October, November, whatever due date is applicable to a respective assessee. So it's very important. Now, because the depreciation has been discontinued by way of this amendment on goodwill, whatever opening balances appearing in your block, your goodwill block of asset of intangible includes goodwill, that should be removed. And that adjustment should be done. So whatever depreciation has been claimed up till 31st March 20, and the WDV of goodwill in the total block should be removed out. That's what provision has been added to 52. Now, once you are not claiming a depreciation, and tomorrow after acquiring a goodwill, if you resell your business to somebody third party and you receive again a goodwill, obviously the goodwill will be taxed as a capital, it will be treated as a capital asset, which has been done, which is non-depreciable capital asset, and therefore capital gain might have to be calculated. And therefore, section 55(2)(a) has been amended to prescribe what will be the cost of acquisition in goodwill. It says the purchase price, the original purchase price, which is we calculated at time of the merger. Now, unfortunately, if you see, this only applies to goodwill in case of the merger. In case of the slump sale, basically the AS14 is not applicable. AS14 only applies to merger and amalgamation transactions. It does not apply technically to slump sale transactions as per AS14. So in case of slump sale, where the business was taken over, for a matter of convenience, whatever amount was being paid over and above was been debited to goodwill. Technically, this amount didn't actually represent the payment for goodwill because there were a lot of other rights which were coming with it. Now, so there were a lot of other rights coming with it. Just to summarize the important points, key points of this amendment is it is effective from 1st April Cost of acquisition of self-generated goodwill will be nil, and you have to adjust the goodwill block as of 31st March 20. You need to keep it in mind. So now, again, coming back to the goodwill issue, in case of this lump sum or in case of the merger, because your AS 14 said you were debiting it to the goodwill, but technically when you are paying anything over and above the book value of the assets, you are paying for various intangibles such as know-how, patents, copyrights, trademarks, licenses, franchises, or any other business or commercial rights of similar nature. It is evident goodwill is not separately covered in this case. So what was we were doing as a matter of convenience as far as slum sale is concerned, and in case of amalgamation and merger, to comply with AS 14, we were debiting it to the goodwill. Now what will happen in case of the merger or in case of this lump sum, you may have an option to divide in case in the books of acquirer, divide this value paid in excess of the book value into various heads. And this is also supported by the various judgments, including Delhi High Court judgment. There is a Delhi High Court judgment of Hindustan Coca-Cola Beverages and Areva T&D India. If you see these judgments are at the time when there was a dispute that whether the goodwill will form part of intangible assets, whether goodwill will be included is in nature of any other commercial or similar rights. So the Delhi High Court said that though the word is being used as goodwill, but technically it does not represent goodwill. The goodwill is on account of payment made for various other rights, such as marketing, reputation, brand name, trade style, territorial know-how, habits of consumers, patents, secrets, marketing rights, business claims, business records, employees, even the employee. You do not get similar employees. That's why you take over. To create these skilled employees for a particular factory or a particular business takes time, and therefore the businesses have been taken over here and there. So you get a pool of the human resources easily at the one stroke. So you are paying a premium for that, and that amount you cannot debit it goodwill. So if what would be possible if I debit all these heads, or if I identify the excess amount under this various heads, still a depreciation would be allowed, because this all items are technically forming part of other commercial rights of similar nature as held by Delhi High Court. Even in case of Bharti Teltech, in this case, when a acquirer actually acquired the shares of the company and also paid certain amount to get the commercial rights for marketing, customer support, distribution, and associate setups, depreciation was allowed. So the question arose that yes, it should be allowed because these are in nature of other commercial rights of similar nature. I may be debiting in the head of goodwill. That does not mean every amount will be a goodwill. So the question that arises now is, an issue that arises now in case of such mergers and demergers, you may have to carry out a valuation. So supposing the book value of the assets is 100 rupees and acquirer is buying those assets for 200 rupees as a part of a merger or the sum sale. The question may arise, how do I allocate this 100 rupees in the books of acquirer? Issue may arise. Now you may have to divide it under various commercial or other similar rights, and then a certain amount may be towards a goodwill. So you may have to get those valuation done by the experts in this field who actually does it, that how you can actually allocate a value to various rights, customer rights. Generally in takeover, we see the intention behind the takeover is the customers which are in the hands of the transferring company, and that customers which are coming to me. So I can allocate to the rights of the customer, the agreements with the customer, lease contract. So I have a lease contract, say 10 years, 20 years of office premises for a brand which is very minuscule. So all those values are there. So you may have to divide it. Now, this may be prone to a litigation because if the proper valuation has not been done and if the allocation has not been done properly tomorrow for claiming a depreciation in the books of transferor, then the assessing officer may say that the valuation is not proper. I do not accept the valuation. This is nothing but a goodwill because it has been debited to the goodwill. So the issues, the litigation which is going on, I believe will still multiply now. It will multiply. Because the Supreme Court had clearly said that goodwill is nothing but the rights. It's a composition of various rights, and therefore the depreciation should not be displayed. But after this amendment, only goodwill has gone out, but other commercial or similar rights have not gone out. So the issue remains, and as the tax advisors, we may have to advise them to take a proper valuations, divide this into various heads, make a separate block under the intangible assets as any other commercial or similar rights, and continue claiming depreciation. In case if you are not claiming depreciation, your acquisition deals, even in the startup companies, which is a very big acquisition is happening day in, day out, where the valuations above the book value is almost sometimes 10 to 100 times. You cannot think of particular numbers. So the acquirer, how do he actually records in the books of accounts if it's a subsale unit of some intangibles? So he may have to do that exercise. Along with the goodwill, as I said, the subsale is very important because in the slum sale transactions, the goodwill is generated and the goodwill is accounted in the books of accounts. So there is an amendment in the slum sale transaction. What is the existing provision under section 50B? What does the slum sale says? That existing provision says, if a unit as a whole, so if I have a factory, I may have 3 factories, but I have one factory, say in Dombivli, Ambernath. I sell that unit as a whole for a lump sum consideration. It would be treated as a slum sale under the definition provided under 2(42) capital C, and therefore it would be chargeable to tax under section 50 capital B. What it says, if the unit is held for more than 2 years period, you have to pay a long-term capital. So you get a tax benefit in case of slum sale, wherein you are paying 20%. That is long-term capital gains rate plus surcharge plus cess. Now the definition of slum sale, which existed in the books before the amendment made in Finance Act 242(1), according to 242C, was transfer of one or more undertakings as a result of the sale for the lump sum consideration. So please mark the words. It was as a result of the sale for a lump sum consideration, without values being assigned to individual assets and liabilities in such sales. So this 242C was a matter of dispute. Various courts have interpreted various other ways. The dispute revolved around the exchange transactions, wherein consideration was not paid by way of monetary considerations, and the consideration was settled by issuance of equity shares. So what the acquirer company was doing, he was buying the unit on a slum sale basis, on a lump sum consideration was decided, and instead of paying a monetary consideration by way of cash or check, this was been settled by way of issuance of equity shares. This was also done by the amongst the intra-group within the group also to restructure, to bring efficiency so that there is no tax impact. So this we used to call it's a tax neutral transactions, because ultimately all the unit is coming into a transfer entity, maybe a holding company or the group company or the subsidiary company, and ultimately there won't be any tax impact because those profits would be taxed over here, and it was treated as tax. There was a judgment of various high courts in this case, wherein it says because the consideration was settled not in terms of the money, it was settled by way of allotment of issue, it is not covered by 242C, especially in Bombay High Court in Bhayander. Now, also there was a Supreme Court judgment which has said that the monetary consideration should be monetary and not monetary. So, and if you compare, there were other different divergent views which says that the monetary consideration, the non-monetary value, in case of non-monetary consideration, the value of that particular non-monetary asset would be treated as a monetary consideration and it should be applicable. So this were the judgments, old judgments in there. So there were divergent views in case of slump exchange. And the majority view which was coming is that in case of slump exchange, there was no tax liability. Only in case of settlement through the monetary consideration, there would be tax liability. Now to overcome this, the amendment has been made in section 2(42C. That how it has been amended. So the wordings which used to speak as transfer of undertaking as a result of the sale. So instead of result of the sale, because the sale was always determined by way of consideration, there could not be a sale without a consideration. That were the views of the ratios laid down by the courts. Now it has been amended to transfer of undertaking by any means. So you may not sell, but if there is a transfer of undertaking in lieu of the shares, it is covered. So all the transfers covered under the definition provided under section 2(47) are covered by any means. You may receive a consideration by any. So in the slum sale exchange, which were not covered now, will be covered. So this will actually put to a question a lot of deals which were tax neutral transactions. A lot of restructuring was done amongst the group without no tax implications. So this is the one amendment. Another amendment has been made in section 50B(2), which is in relation to calculation of long-term capital gains in case of slum sale, which according to initially, as per the existing provisions, the consideration, the transaction value was been acceptable under 50B. Now the amendment has been made in the subclause 2, it has been provided that the fair market value of capital asset instead of book value shall be considered as a consideration. So fair market value, it has been replaced like a fair market value, which has been done in case of 50C, 43CA, 56 provision. So various places they have tried to replace the fair market value concept with the transaction value. Fine, fair enough. For the purpose of calculation of fair market value, they have prescribed new rule which has just come in the last week of May under Rule 11UAE. If you actually go into this Rule 11UAE, you have to actually value individual items in this particular unit. So individual items in the sense, it's a book value of all other assets except immovable properties, that is land and building, which you have to take it based on the fair market value or the stamp authority value, number one. Then there are other assets which have been elevated, that is a downstream investments into subsidies. So you are buying investment also as a part of some sale. So those investments will have to be valued, securities will have to be valued based on the rules prescribed under 11UA. So it also refers to 11UA and UA, which is in relation to valuation of shares and property. Now the basic concept for prescription rule is against the principles of Section 50B. Section 50B and definition provided under 242C. 242C says transfer of undertaking by any means for a lump sum consideration. Now, if I am able to divide this consideration into while calculating the fair market value onto the various assets, it goes against the concept introduced in the definition section itself. It may be questioned that whether it is at all a sum sale. If I am valuing a particular unit before transfer and at that value, if it has been transferred and these values are assigned to individual asset, it loses the basic characteristics of the sum sale. So the sum sale will be questioned now. So assessing officer may say, you have an individual valuation done under 11UA, why should I treat it as a slum sale? And if I do not do it, he will invoke 11UA for the purposes of taxing it. He will do a valuation and then tax me on the fair market value. So this issue remains. The rules cannot go beyond the slum sale. And according to me, this is not correct. But transferor, this is for the purpose of transferee, because transferee has to pay the capital gains. For the purpose of transferor, as we saw in the case of the Goodwill, he may have to still value those difference paid over and above the book value to allocate it in the books of accounts. Under what head he has to allocate? What is for patent, trademark, what is for patents, what is copyrights, what is any other commercial or similar rights, and goodwill if any, so that he is able to claim depreciation accordingly. They have to do that. So this is the amendment which has been made to themselves. So if I have to compare the existing position of impact of fair market value 50B to amendment which has been said, if I am receiving amount received by transferor is greater than fair market value, in the hands of the seller there is no impact because he has to pay tax on the amount received. It's already greater than fair market value. In the hands of the buyer, excess consideration need to be recognized as a value for goodwill or for other commercial right of similar nature. So you may have to do an exercise because the goodwill depreciation will not be allowed. On the other commercial rights, depreciation will continue to be allowed. Amount is received by transferor which is less than fair market value calculated under 11UAE. Then the seller will now have to pay higher capital gains because of deeming fisher provided under 50B subclause 2. He will have to pay on the fair market value rather than on the transaction value. Now, obviously, the fair market value is higher. Actual amount received by transferor is less. So the short consideration, he will record the assets in his books of accounts which have been received at the time of the slump fair at the fair market value. And the balance may be recorded as a capital receipt, short consideration paid, which should not be treated as taxable. No 56 should be applied accordingly. Now, this will be applicable for financial year 2021. So this is basically the amendments in relation to goodwill and the slump sale. The another major amendment is in relation to 45(4)(a) and which has opened a lot of issues. What is 45(4)(a)? See, the government, there are various, if you go into the history, there are judgments to the extent that whenever there was a reconstitution of a partnership firm or there is a dissolution of partnership firm and the assets were given to them or the amounts were withdrawn by the outgoing partners, there are various judgments, which you'll see in the other slides, that this was not a taxable. Government, the courts have held that under the Indian Partnership Act, there is no difference between the partners and the firm. Partners and the firm is not different. They are jointly and severally liable. And therefore, there is no transfer of any asset between partner and partnership firm per se. The rights in the assets of the partners are sacrosanct. They remain even if the firm is there or even if the firm is dissolved. The rights do not get extinguished. And the partner's right is actually derived from the partnership asset itself. And therefore, even if the asset is held by the partnership firm, but ultimately it's a partner who is having the legal right. This is the background. This was not liked by the government, I believe. Therefore, the 45(4) amendment was made. Existing provision has been replaced. What did the existing provision say? That any dissolution or otherwise, any distribution at the time of dissolution or otherwise, the capital gains tax in the hands of firm only in case of a transfer of capital assets. Reconstitution and retirement of partner, no taxation of capital gains by various courts. The various courts have held that. And distribution of money, no taxability in lands of the money. If you see in the builder's case, landowner's case, where the landowner is one of the land party and the developers are entering into a partnership firm, comes join as a partner, the existing landowner revalue its assets and the revaluation portion of the land debited to land is credited to the partner's account. Hereafter, the new partners come in. The old partners withdraw their capital account, which is brought in by the new partners. In effect, the old partners, retiring partners, were technically going out of the partnership firm, relinquishing their rights in the partnership firm, which was now owned by the new partners. And there was some transfer happening, and distribution of money was happening, or sometimes capital asset was distributed, and this was not being taxed under 45(4), which is not liked by the partner. And therefore, the amendment has been made under section 45(4). What does the 45(4) amendment, the new provision, amended provision says? It says the capital gains tax will be chargeable in hands of the firm on receipt of money or capital asset by a partner representing his capital account balance on reconstitution. So initially it was in relation to dissolution or otherwise did not include a reconstitution retirement as held by the various courts. Now it only restricts itself to reconstitution. Dissolution is not covered under 45(4), but a new section has been inserted under section 9 capital B, wherein dissolution is covered. So 45(4) says if there is the capital gains will be taxed. What does the 45(4) does is it creates a charge of capital gains tax in the hands of firm on receipt of money or capital asset by partner. Capital gains tax will be chargeable in hands of the firm. Though the money is received by the partner or capital asset is been received by the partner, chargeability of capital gains tax will be in the hands of the firm. The chargeability for the purpose of the calculation, you have to calculate the value of the monies which are actually realized, and the fair market value in case there is a receipt of capital asset. What would be the cost while calculating capital gains? The balance in the capital account would be the cost. So this is how the new formula would look like. It would say the value of, for the purpose of calculation, value of money received, add fair market value of any other capital asset which is received, less cost of acquisition, which will be balance in capital account. While calculating balance in capital account, the revalued portion, if any, if the capital account balance was credited by any notional entries like revaluation of assets, such journal entries, the effect of such entries should be removed, and then the capital gains will be calculated. This is what 45(4) is. Along with this 45(4), now new section has been inserted called section 9B. The background of section 9B is, before this, there was no taxability on distribution or allotment of assets by a partnership firm upon dissolution or reconstitution. Is nothing but a mutual adjustment of rights between the parties. There is a Supreme Court judgment in case of Malabar Fisheries, which held that a partnership firm under the Indian Partnership Act is not a distinct legal entity apart from the partners constituting it. So firm is not a distinct legal entity apart from the partners as far as Indian Partnership Act is concerned. The firm as such has no separate rights of its own in the partnership assets. And when one talks of the firm's property or the firm's asset, all that is meant is property or assets in which all partners have a joint or common interest. Very important gentlemen. If that be the position, it is difficult to accord the contention that upon dissolution, the firm's right in the partnership assets are extinguished. The firm as such has no separate rights of its own in the partnership assets, but it is the partners who own jointly common assets. So in case of even dissolution, it was held that there is no, it cannot be taxed. So 45(4) was under statute. So what the new 9B says now? The new 9B amended says income on receipt of capital asset or stock in trade. So stock in trade was never covered earlier. Now it has been covered because in case of developers, where the unsold units are there and the partnership firm wants to be dissolved or reconstituted, the unsold stock has been distributed amongst the partners. In those cases, there was an argument which was being made that these are not capital assets and therefore 45(4) should not apply. Those are stock in trade as far as the developer and builder is concerned. Now 9B covers the stock in trade also. What does the 9B contention, the main important limbs of 9B are? It is an income on receipt of capital asset or stock in trade or both received in the hands of partners or members from AOP boy firm. I'm referring to partners and firm. This should be also constituted by received by members or AOP boy wherever. At the time of dissolution or reconstitution. 45(4) applies only at the time of reconstitution. 9B applies at both times. To be taxable as a capital gains or business income as the case may be. Capital gains in case of capital asset, business income in case of stock income. For the purpose of this reconstitution has been defined under section 9B itself. What does the reconstitution include? One or more of its partner or members cease to be a partners or members. So any retirement, even if one partner is retiring, it would be treated as reconstitution. 2, one or more new partners or members are admitted. So any admission is reconstitution. However, at least one existing partner or member should continue to be a partner or member of specified entity after admission of the new partner. So one existing partner should continue and new should be admitted. It should not happen that all the new partners are been admitted and all old partners are retired, because there are judgments which says this is akin to dissolution because everybody has gone. And nobody is akin to a dissolution. So it is like that. All the partners or members continue. So there's no retirement, no admission, but there is change in PSR. That will be covered under the reconstitution. So in case of reconstitution, which falls under definition, the provision of section 9B as well as section 45(4) will apply. 45(4) will apply if it's a capital asset. Then 9B will also apply. So there is a dual calculation at both the places. There is a provision for avoidance of double taxation. The stock in trade will apply. But please note, the basic 9B will apply only if there is an income on receipt of capital asset or stock in trade. So the outgoing partner should actually receive some asset or stock in trade. Or if there is an admission and the shares of the partners are adjusted, because of this adjustment, the partners whose shares have reduced receive something. So he has to receive. If it is done without any receipt, no application of 9B and 45. How do you calculate for the purpose of 9B? It's a fair market value. Computation the gains arising from deemed transfer of stock in trade. Transfer of stock in trade taxable in the hands of firm as a PGBP income. So because it would be as good as treated as, say, you have to take a fair market value. In case of a jewelers, you may have a stock at the average cost of 30,000. The price fair market value today is 50,000. So if there is a retirement happening and some partner is going out and he takes stock along with him, let's take two brothers are splitting and the stock has been taken in, now it would be taxable at the differential price because in the hands of the firm, it would be treated as sale of stock in trade and therefore it would be taxable. For computing the capital gains, the formula under 9B rate with 48.3. Why 48.3? Because in case of reconstitution and receipt of capital asset by a partner, that is a tax liability under both the sections, and therefore 48.3 provides for a deduction in respect of tax which has been already paid under 45(4). What it says, from the fair market value of assets, you reduce all expenditure cost of acquisition improvement as generally provided under our capital gains, which we do, plus amount chargeable to tax as income of firm under 45(4). So what the amount has been already be charged under 45(4) would be reduced for the purpose of 9B, so there is no double taxation. Then the exemptions which you can claim under 45(4). So just to summarize it again, 45(4) is applicable at the time of reconstitution, at the time when the income arises on receipt of money or capital asset, no stock in trade. So money, capital asset and reconstitution. 9B is applicable on dissolution as well as reconstitution, but on receipt of capital asset or stock in trade. Capital asset being common, 48.3 avoids double tax. This is a summary sheet which is only for a presentation in which all circumstances 9B and 45(4) would be applicable, which could be referred. We have already discussed in earlier slides in details. What are issues that have arisen? As I said, whenever there is an amendment, there are issues. There could not be a clarity. Let's take in a question now, very first. The issues under 9B in this case. taxability is the year of receipt of asset by partner. If assets are received in different years, tax will be levied in those years. Let's take an example. The retirement happens in 31st March 21 and I receive an asset in April 21. What would be the taxability? Or I receive money in March 21. I receive capital asset in April 21 because there is a formality to be transfer time. It takes time to transfer. And I have already retired in March 21. What it should be? According to me, it should be appropriated over a period of a year because the taxability arises on receipt. Unless and until it is received by the partner, the firm cannot be taxed in case of 9B. Next question. 9B applies to dissolution. Now the question arises, in case of 9B as well as 45(4), if you go, the tax has to be paid by the firm. Now on the date of dissolution, firm becomes dead. Firm is not in existence. So what happens? How would you levy tax on dissolution from dissolved firm? How would you do it? So that issue arises. Now there is a section 189 which says that in case of dissolution of the firm also, it will continue to be assessed for the purpose of tax. And there is no need to have a separate. That section is created not for purpose of section 9B. It has been created for the firm which will continue when one resort to 189. The question is that. So according to me, section 189 will still apply and there is no need of separate fiction to be created under section 9B for the existence of firm. 189 will be applicable. So even in case of dissolution, the 189 will be imposed and for the purpose of taxation, it will be assessed. Issues under 9B. Now very important. Again, 9B says that fair market value of asset shall be the full value of consideration. We have seen fair market value. For the purpose of fair market value, how to be calculated is provided under various sections of 50C, 43CA, section 56. But in case of 9B, there is no computation mechanism given for the fair market value. We saw there is also 11 UA prescribed in case of sunset, but for 9B it has not been given. So obviously there's a definition of fair market value under section 2 bracket 22 capital B. I'm sure we need to apply that. So as per the definition, in case of immovable property, there is no mandate for adoption of stamp duty valuation or guidance value. Fair market value is the price which would be fetched if the asset is sold in the open market by a willing seller. So as per 222B, it's a fair market value and not stamp value. In most of cases where the fair market value has been determined, the rules in relation to those sections says that a fair market value will be equivalent to adoption of stamp duty value. But for the purpose of 9B, it should be the fair market value, which would be asset will be fetched in the market. So you will have to do the valuation from that approved value. What is the fair market value based on the transactions which are happening in the remote connections? So based on that, it will be. Now, at the time of assessment, let's take an example. In city like Mumbai, in city like Thane district or Bhayander, you will find the fair market value of asset sometimes been less than the stamp duty. I know the place in the South Mumbai where the fair market value of the asset is 30,000 per square feet and the stamp value is 40,000 per square feet, and because of which the transactions are not happening today already under 50 because of worry under 50C and 56. These transactions are facing difficulty. So similar difficulty may arise. I may take a fair market value for the purpose of section 9B and the assessing officer will tell that see stamp duty value itself is higher. So if the fair market value determined by registered value is not fair, is not really fair. So he may question that. But obviously, according to me, because of there is no prescription at the fair market value. 222B says that actual fair market value, I should take a actual fair. If it is less, it should be acceptable. Though there may be an issue, there may be a litigation, but most likely the assessee should succeed in this case. That stamp duty may be higher. And if the fair market value is above the stamp duty valuation, and if I'm myself reporting that, that's not a problem. Question arises, can the fair market value, even if it is above the stamp duty value, can be questioned? According to me, the report issued by a government approved value, if it is considers all the parameters, it should not be questioned and it cannot sustain the legal background. New section 9B. Now there is issues in the 9B. Why the 9B has been inserted? Because it covers both capital asset and stock in trade. Technically, if any amount of taxability under profits and gains of business, it should form part under section 28. Now there is no amendment made in section 28. Section 28 deals with profits and gains of business or profession, which has not been amended to include stock in trade received by a partner or dissolution or reconstitution. This has been included in 9B. After if you go through section 28, the way we calculate, after section 28, all incomes are calculated. And section 29 permits you the expenditure deduction to be computed in accordance with section 3243D. So all expenditure is concerned. Now the question arises that because there is no amendment in section 20, your income has been taxed under 9B on the receipt of stock in trade in case of reconstitution or DG conversion, whether the deductions provided under section 3243D will be available or not, because there's no amendment made in section 28 that that's then this is a one view. The other view is that section 9B subclause 2 subclause Roman 2 small clearly stipulates that income under the heads profits and gains of business will have to be computed in accordance with the provisions of the act. That means all other provisions should be applicable. Hence, according to that 3243 they will apply. But this problem arises. So the assessing officer may put a question that though the amount is chargeable under 90, no other expenses will be allowed because it is not included in 28 and there's no clear in section 29. Issues under 9B again. Whenever 54 EC presupposes receipt of consideration and investment of capital gains in eligible bonds. In absence of any consideration received by firm, it cannot claim exemption under section 54 EC. Now, what does a 9B receive? Consideration, actually receipt is in the hands of the partner. And the capital gains tax has been paid under 9B or 45(4) under 54 EC. Now, if I am not receiving any consideration, can I actually invest this amount and claim a benefit of 54 EC? The question will arise there. Because the 54 EC already presupposes that I have received some consideration. And therefore, that consideration has resulted into capital gains, which has been invested in the bonds, and therefore 54 EC is applicable. Now, in case of 9B, it's like a reverse charge, जो GST में होता है, reverse charge है. So tax asset उनको मिल रहा है, consideration partner को मिल रहा है, capital gains tax मुझे firm को भरना है. So जो firm को tax pay करना है, whether I will get a benefit of reinvestment under 54 EC is the question. So the one view says it should not be because there's no receipt of consideration in the hands. It's only they are made to pay, but technically the capital gains is taxable in the hands of individual or not. The other view is that 54E does not specifically refer to consideration. It only requires investment of an amount equal to capital gains. The question is, what does 54 requires? It only requires investment irrespective of receipt of consideration, or only if I receive a consideration, investment has to be made. Hence, further, that view, I hold another view, it says the firm can claim a deduction under 54C in respect of capital gains computed in 9B. In case the 9B is attempted on account of dissolution of firm, it is not possible under 54C. Or I should refer a matter to section 189, where the firm continues for the purpose of tax. But how will I invest in the bonds? Firm is dissolved. I pay capital gains. Firm pays the capital gains in the hands by virtue of section 9B. I want to reinvest. I don't want to pay tax. How would I? Because the firm is dissolved. Firm is not continuing. So I can't hold bonds for 5 years. Firm is dissolved. In reconstitution, I may continue the firm. As a W firm, there's nothing, there's no transaction. Still, I will continue for the purpose of the bonds. So this issue may remain. So in case of dissolution, according to me, it's very difficult to claim 54 EC. It cannot be claimed. But in case of reconstitution, according to me, the better view would be 90. But I think so there should be some clarification in this regard. Issues under 45(4). Partner should receive money actually, whether credit to capital amounts to receipt. Let's take an example. There is a reconstitution of the firm and my share has come down. So the partners remain same. But I was 20% and it has come down to 10%. Because I've reduced my 10%, certain amount is payable by the other partners whose share have increased. That amount is credited to my capital account and debited to their capital. Whether this amounts to this. I do not actually receive the amount. This is called a case of constructive receipt. So whether it should be taxable at the time of constructive receipt itself, or it would be taxable when I actually withdraw the capital account and receive the money. Question is, there are various both sides judgments which says the receipt includes constructive receipt. But in case of a constructive receipt, basically, because the partner's account is credited and one partner's account is debited, firm do not receive any amount and tax is payable by the firm. How would firm pay tax? So the question is whether it should be receipt or not. This issue remains unresolved according to me. And according to me, the receipt should include constructive receipt. And my view would be that even a credit to capital account amounts to a receipt and it can be withdrawn at any point of time because there is no restriction. And this constructive receipt should be considered for the purpose of taxation. If a firm owns an agricultural land, which is not a capital asset under section 214, does the 45(4) will apply? According to me, it will not, because 45(4) talks of capital asset. So only receipt of capital asset in case of 45(4) or 9B for that matter will be there. If the agricultural land is classified as a stock in trade by the firm, then obviously 9B would be applicable because it's a taxable. Third issue. What happens when a partner dies and the legal heir receives the amount in excess of capital account steady to credit of business? So legal heir ko partner ka 100 rupiya tha. My partner, my husband expired. Spouse receives 120 rupees. This 20 rupees is towards the revaluation of certain assets which is better. So as a legal heir, the spouse receives 120. Question is whether 9B and 45(4) will be applicable. Of course, it's a receipt of money, then only 45(4). If there is a receipt of capital asset, both these sections. Question arises for considering whether it would be applicable. In absence of specific provision to this effect, legal heirs are not liable, and section 159 also does not apply as there was no receipt at all by business partner. In my view, because there is no specific provision that it would be in case of dissolution or in case of when the partner expires and the legal heir receives, there is no specific provision that it would be taxed. Tax is when it is received by partner, not received by somebody else. It's received by the partner. So the legal heir receives, and even under section 159 will not apply in this case according to me. And technically it should not be taxable. There should not be any tax liability created. So in case of death, and wherever the distribution of money, capital assets, or stock in trade happens, to my view, it should not apply. Because the amount is going to legal heirs. Another issue. If you, for the purpose of 45(4), the cost of acquisition is balance in capital account less any notional entries made in the capital account by way of revaluation. That is how we calculate. We saw it before. Question arises over here. If there is a balance in the current account or in the loan account, whether it should be treated as part of capital account and the amount should be reduced towards the cost of acquisition. According to me, balance in the current account could be appropriately called as a part of capital account, but the same may not be in case of loan by partners because the ranking of loan is higher than the partner's capital account. Generally, in the partnership form, we only include it in case all amounts over and above fixed capital are credited to current account, and there is nothing to call concept of loan from partners. It's a current account only, and therefore the firm may not be. But in the LLP, I've seen it that there is in certain cases, in certain agreements, the amounts are not credited to current account. There's a fixed capital, and whatever amount is brought over is credited to loan. The reason being, the loan, creditor will have a better right than the partner. So his loan would be settled first in case of defaults. So he would have a right of a creditor. A current account balance does not have a right of a creditor. Now the question arises, if I'm crediting into a loan account, whether it will be treated as cost of acquisition if I get something over and above. According to me, no. Because if some partner has been retiring, he will be first paid the balance in the loan account by way of money or capital asset. So whatever money or capital asset is receipt or stock in trade will be first adjusted towards the loan on a principal to principal basis on the balance. To that amount, it will be not taxed. Balance only would be treated as consideration towards the 45(4) according to me. So it should be not be taxed. So in a way, though I am getting a benefit, but it will be not treated as cost of acquisition for 45(4). Similarly, in the case of LLP, there is a provision wherein we credit it to reserves. Whatever profits are credited to the reserve should be credit balance in P&L or balance in the reserve should be credited to partner's account before dissolution reconstitution. In case any payment from such creditor cannot be regarded as payment in connection with it. So it will go to that extent. Whether those credit should be also treated in the balance. According to me, it should be treated. Cost of acquisition should be allowed because it is a distribution of capital. Reserves is a distribution. It is a tax paid on that amount. So this takes up 3 due amendments. Now, another important provision of 45(5)(a). If you go to an history, there is why the 45(5)(a). This amendment came 2 years back. Whenever a landowner was entering into a development agreement with the developer in lieu of certain premises to be received, so it's not a monetary consideration; it was a non-monetary consideration by way of the constructed units to be given. So there was a dispute revolving what would be the time of taxability. when I entered into a development agreement, get it registered and give a notional possession to the developer for constructing a new building thereon, or when I actually receive the possession of the constructed unit, which is my consideration as per the agreement. So what should be that? That should be that the question arose in. So this question was been arose. To resolve this issue, 45.5 was inserted, which says in case of individual NHF, if he enters into a specified agreement, capital gains shall be chargeable in the year in which certificate of completion is issued by competent authority. So the timing, though I am entering into a development agreement, there's no taxability. So it resolves a lot of issues as far as individual NHF is concerned. But what happens to the other assessors? There may be a landowner who is a private limited company. There is an LLP who enters into the specified agreement for purpose of receiving on a consideration that I will receive a non-monetary consideration by way of constructed units. What will happen in those cases? So the litigation continues. Unfortunately, it will continue according to me. Because assessee is going to say 45.5 is only applicable to individual HUF, not to the other assessees. So in this case, I will charge the capital gains tax on the date when the development agreement is such, because you have granted the possession to the developer of the land, you have transferred the FSI, you have transferred the TDR, I should tax it today. But according to me, in case of other assessees, there's a judgment of Calcutta High Court in case of Infinity Infotax Parks Limited, wherein it says that no transfer within the meaning of section 247 would take place until builder has constructed said property and handed possession to assessee as per the agreement. So this judgment of 2018 is already in place. I could also argue in case of individual and HAFs before the amendment came into 45.5A. Though the amendment will, after amendment, there will be no litigation as far as individual and HF. So it makes my life simplified. But in case of the pending litigations, Calcutta High Court comes to my rescue, which says till the time I receive the possession of the constructed units, which is allotted to me as a part of consideration under the specified development agreement, will not be taxable till the time I receive the consideration. It is very important in case of other assessees, because in case of other assessees, the litigation is going to continue under 45.5A, and we can resort to this judgment. Important again, 47.13B, transactions not regarded as transfer. The 13B is in regard to transfer of capital asset on conversion of private limited company to LLP is not considered as transfer, provided conditions stipulated in that subclause are fulfilled. In case of non-compliance with those conditions, the exemption shall be withdrawn and the gain arising on assets transferred shall be taxable in the year when the conditions are not fulfilled. So we all are aware on conversion of private limited company to LLP, which was that was the idea behind the LLP, that private limited company should be converted into LLP because private limited company suffers the double taxation and therefore there would be exemption granted. But unfortunately, conditions were granted and it restricted only to the companies with an asset less than 5 crores and the turnover in last 3 years been less than 60 lakhs something. Now the question issues is they are trying to exempt. What they are trying to say that conversion of private limited company to LLP is a transfer, and therefore I am exempting if the conditions are fulfilled. The question that arises to my mind that conversion itself is not a transfer. There are various judgments wherein firms were converted into a private limited under Chapter 9, and it has been held by the various courts that the conversion is not a transfer and it cannot be exigible to capital gains. So once the transaction is not a transfer, what you are exempting? You are trying to exempt a transaction which is not a transfer. So the concern, the view of the assessee would be that there is no transfer, so there is no tax at all. That is my view. But department says, sorry, it is a transfer. There will be a capital gains tax. But if you fulfill the conditions, I will exempt. So this controversy remains whether it is a transfer or not a transfer. Now, unfortunately, a judgment has come. The issue that arises, let's presume that this is a transfer because of one judgment of Celebrity Power LLP, which says because there is no statute does not prescribe such conversion, it would be taxable. It distinguishes the judgments which were given for the purpose of conversion of firm into the company. It distinguishes from company to LLP those judgments, and it says it would be taxable. Once this transaction is taxable, If you fall under 4713B, you prescribe, you fulfill the conditions, it will be taxable. It would be exempt, otherwise you have to pay the tax. Now the issue over arises is how the capital gains will be calculated when all the assets are transferred at book values. Now the capital gains is taxable, is consideration minus cost of acquisition. I'm transferring all my assets at the book value. So obviously my consideration and cost of acquisition is nil. So capital gains would be nil. So how do you tax in the hands of the company? The transfer is at book value, so I do not, there is no prescription that you should take a fair market value for the purpose of 4713B. There's no such thing. So according to me, the provisions of capital gains are unworkable. If I do a conversion, that cannot be taxed. This position is appreciated in this tribunal judgment also, that how gains will be taxable. But that remains a one gray area again, which is unresolved. Whether there can be taxability in the hands of the shareholders. The shareholders, as I said, receives now amount by way of credit to a capital account. Now it's a constructive receipt. So my rights in the shares have been extinguished, and with instead of that, by way of consideration, I am received value in terms of money by way of credit to capital account. So whether there is a change of nature of capital asset from a right from a shares to right in a partnership. So that is a transfer, because there is an extinguishment measure, that there could be a transfer. If that is that, there could be a tax. If the question arises, how would you tax it again? Obviously, my shares have been held at face value at 10 rupees. And the value of the shares on the date of conversion is 100 rupees, because 90 rupees is the reserves, accumulated profits. So obviously, I'll get a credit of 100. So should I pay tax between 10 and 100? How should I do an indexation? From which date? How should I pay? There is no receipt. So this all issues still resolves that how will you tax in the hands of the shareholders, which remains. So this provision remains totally, even today, issue based. We have seen that a lot of conversions have not happened because of this restricted clause, this obnoxious. My view is it should not be treated at transfer. I do not, though there is a judgment of celebrative power, but obviously we do not have any judgments today of High Court or Supreme Court, and the time will tell. But of course, now after the tax rate, which has come to 22% in corporates, a lot of people are considering really whether I should go to LLP. Though there is a double tax, I have to pay a dividend tax when I distribute balance 78 rupees. I have to pay 30%, 10%. Still, a lot of people are not considering because they may not distribute dividend. They may continue to pay tax in the hands of the company, continue to build capital in the hands of company and create assets. So how sparingly now this would be used, but the issue remains. So the purpose for which the LLP Act was actually incorporated, according to me, that has been less lost, because not much take-up has, not much activity has happened in such conversions. Another important issue, according to me, I would say it's resolved, but the issue remains because our chartered accountant fraternity, most of them I have been interacting with our professional brothers, they are actually not accepting this position, they're paying higher tax. What is it? First, let us take this. In case of a depreciable asset, the tax is computed under Section 50. Under Section 50, what it says? That if you sell any particular asset and your block becomes nil, so आपका block है 100 rupees का, और आपने block में से asset में से एक asset ही बेच दिया, आपने दो बेचा भी नहीं, block में asset पड़ा है, but actually value of the block under income tax is reduced. So 100 minus 200, 100 रुपए के ऊपर Section 50 में you have to pay tax. It says you have to pay short-term capital gain estimates. You have to pay tax under capital gains. It does not talk of short-term or long-term. It says you pay tax under capital gains. Now, once it has been taxed under the capital gains, there is a provision of Section 54EC which says that in case any capital gains arising from a long-term capital asset is invested into a bonds prescribed under 54EC, you will get exemption. Now, the question here was that whether this is a long-term capital gain or a short-term capital gain, and therefore the capital gain arising because of sale of a depreciable asset should be eligible for investment in 54EC. Bombay High Court settled this issue in case of Ace Builders, which says Section 50 is a dibbing fiction, which is only restricted to computation of capital gains. It only says that WDV minus consideration is a capital gain. So you do not take as. It never says whether it will apply, this provision will apply to other provisions of that. Therefore, exemption in the 54C will be available on sale of depreciable asset. The Ace Builders recognizes that ultimately the asset which has been sold is a long-term capital asset. 54 EC says that long-term, whenever long-term capital gain arising on a long-term capital gain asset will be eligible for 54 EC reinvestment. So though the calculation is done under section 50B, and for that purpose it is treated as short-term, no indexation is allowed. That is only for computation under 50. But while other provisions of Act will still apply, and therefore even that amount can be reinvested and you can take benefit. Now, good as of now. Now the question arises, when the Bombay High Court judgment says that other provisions of law will not apply, deeming fiction is only restricted for the purpose or the objective for which it is enacted. It cannot be extrapolated to other provisions of the Act. The question arises, the long-term capital asset is chargeable to tax under section 112 at the rate of 20%, whereas short-term capital gain is taxable at the normal slab rate, that is 30% of the capital. So whether I can use this judgment and say that the asset which has been sold, I have calculated capital gains under 50, but while applying the tax rate, while applying the exemption benefit like 54 is, I will apply the tax rate 112 and pay 20%. According to me, that view is good, which has also been now upheld by Honorable Mumbai Tribunal in case of Manali investments, which held that asset remains a long-term capital asset. Long-term capital gain is claimed on sale of asset. Therefore, LTCL available can be set off. So now you can also set off the Manali investment was not on tax rate. It says whether long-term capital loss can be adjusted against such gains under section 50 of depreciable asset. Most of us are not doing it. Manali investment says you do it because that profit is ultimately from a long-term asset, though calculated under 50. So you adjust long-term capital loss. Similarly, I will apply tax rate applicable under 112, for which there is a judgment of Smita conductors under Mumbai trial that all the provisions will apply. So all these judgments are in your favor. So now what the practical problem is happening, I'll tell you. If you file the return of income in case of depreciable assets, when you are reporting a sale consideration against WDV, what does your form does? Your utility does 100 minus 200. 100 rupees ko automatically takes you to capital gains as a short-term capital gain and calculates 30% tax. Whereas if I want to apply this judgment, I have to pay 20% tax. Your return, your utility also does not allow you to take adjust long-term capital loss against that. So this is the problem what is happening. Now you have to do some tinkering because the law is in your favor, though the systems are not in your favor. So what you may have to do, though my block value is 100, I have sold for 200. I will only credit 100 over here. Take a nil, so short-term gain reported as nil. Balance 100 I will report as long-term capital gain. Adjust long-term capital loss if any. Balance I will pay tax and then 112 and 20%. According to me, this would be proper under the law. We should pay 20% tax and not full tax on such assets till the time if amendment comes. There is no amendment in this regard today. Another important amendments which have been made since assessment year 2021 and 2022 is in regard to the residence provisions under section 6. If you recollect, in the last Finance Act, 6(1)(a) was inserted by Finance Act 2022, which says, as per 6(1)(a), an individual who is a citizen of India and has a total income exceeding 15 lakhs, excluding foreign source income, Indian source income, then he shall be deemed to be a resident in India only if he is not liable to tax in any other country. So अगर आपके 15 लाख से ज्यादा इनकम इंडिया में है, आप वैसे नॉन रेसिडेंट हो टेक्निकली, लेकिन आप इंडियन सिटीजन हो, आपकी इनकम 15 लाख से ज्यादा है इंडिया में, और क्योंकि आप कोई भी अदर कंट्री में लायबल टू टैक्स नहीं है, तो आप इंडिया में डीम्ड सिटीजन गिने जाओगे अंडर 6(1) और आपको रेसिडेंशियल टैक्स के प्रोविजंस लगेंगे. So lot hue and cry हुआ उसमें. Then there was an amendment made in section 6 when it said that fine, you will be treated as a resident, but you will be treated not ordinarily resident but not ordinarily resident. So उससे क्या होएगा कि your world income will not get taxed unless you have a business which is controlled from India or you have a business operations in India, which will be taxed. Of course, fine. Till that extent, I appreciate. Now there was a controversy. What do you mean by liable to tax? Does liable to tax means actually payment to tax? There was no definition provided in the law. Now 229A by this Finance Act has been inserted for inserting a definition of liable to tax, according to which liable to tax in relation to a person, I mean with reference to a country, means that there is a income tax liability on such person under the law of that country for time being enforced and shall include a person who has subsequently been exempted from such liability under the law of that country. So it includes, you should be liable under that. It never says if you are liable to tax under laws of that country, but you have been executed, still you would be liable to tax. And 6A1A will not apply to you because you are liable to tax in that any other country. You should be liable to it. Basically, this amendment was made to cover such persons who are not liable to tax in any other countries because they keep on moving from one place to another. There are 90 days in India, there are 90 days in USA, 90 days in Dubai, 90 days in maybe UK. So all 4 countries. So they don't become liable to tax in any of this country because they don't become residents of any country and they are floating in air. So to cover up such transactions, 618 was inserted. And because of hue and cry that world income will be taxable in case of Dubai or this, a liable to tax definition has come. According to me, this is quite good and clear. So the income tax has, on the basis of category, it's a resident and it will be RNOR in such cases which are the deeming provisions. So once an RNOR are there, and also there is another amendment in 6.1 wherein this 180 days period, the person who is on visit to India and he is staying in India for more than 150 days were considered for the purpose of residency. It was reduced to 119 days. So it's India should not be more than 119 days now. So again, 6.1A which we have covered. What are the implications of this amendment? This is very important we need to see. Of course, you become RNOR. Your world income does not get taxed unless it's in relation to a business income control or appropriate in India. But there would be following consequences. So even if you are a resident and NOR, but still other impact which will be is you will have an increase in scope of total income, as I say. There will be loss of exemptions which are otherwise only available to a resident, clear residents or non-residents. Loss of concessional rate of tax presumptive scheme benefits. Benefits provided under DTAA because you are not a resident, you are a resident of India, so DTA will be lost. DTA is available when you are a resident of other country. You will have to report foreign assets. Most importantly, you have become RNOR because of this provision technically, but you are not actually staying in India because you are not liable to tax in any other country, and you have become a resident of India, being an Indian citizen. Now you will have to report all foreign assets. So this is a very major impact. Increase onus to substantiate because you are a resident, onus will increase, you will be answerable to Government of India, and uncertainty in rate of deductions. You will be treated as resident for the purpose of rate of deduction. So whether I should apply 194 who is making a payment of 195 because your taxability still is under RNOR. So this issues will remain. Another important issue is in regard to delayed payment of employees' contribution on PF and ESIs. Now this is a dispute. Department says it is covered under 3615A, the small money. We say it is covered under 43B. Department says that because it is covered under 3615A, once you have lost the bus, that is the due date has been lost, even if it is deposited belatedly, it will not be allowed. We are saying if it is deposited up till due date of return, it will be allowed because Section 43B may be covered by employees' contribution. They say only employers' contribution is covered under 43B. Now this matter came before the Bombay High Court in Ghatke Patel Transport, which says that even employees' contribution is covered. Now to cover up this, there are contrary judgments obviously, but I am relying upon my jurisdiction High Court that says it is covered. So I used to make a claim. We have seen the lot of 143(1) adjustments happening in this areas, wherein if the tax auditor has reported a delay in the payment, but we have not disallowed in the computation considering the applicability of 43B provisions. 143(1) prima facie adjustments have been received, disallowing these claims and making an addition. Now it may be pending at the rectification level or the appeal level. Now the question here arises: the amendment has been made by this Finance Act, making it applicable from financial year 2021. Now, if you see the wordings of this explanation which has been introduced, it indicates that it is a clarificatory, is in retrospective in nature. Clarification. It's a clarification which may be retrospective. However, it very clearly again says also that assessment year, it will be applicable from assessment year 21-22. Now, in case of a clarificatory explanations, there are various judgments held in favor of assessee, when any benefit is granted to the assessee, that those are retrospective in nature. So the question may arise, the department may with you, because these are clarificatory in nature, why it should not be applied retrospective, and all the pending assessments which are pending, in those cases I will apply the amended provisions and I will disallow. You cannot. According to me, that view may not be good because it is putting an additional burden. Though it is worded as clarificatory in nature, budget also clearly says that it is applicable from assessment year 21-22. So for this financial year, you should disallow, according to me, when you are filing your tax audit report and contribution also. But for the earlier years, you still start claiming and you may dispute it, according to me. It cannot go retrospective, but this issue may remain because AO may not allow based on the wordings issued is clarified. We can also argue an alternatively that because the amendment has been brought from 21-22, that means that government recognizes that before it was allowable, and that could sail through. There is very important change which daily I am being asked questions on this whenever I interact with the professional brothers in regard to the new provisions in regard to reopening of assessments. Now, section 148A is a new section which has been inserted, according to which assessing officer, before issuing a reopening notice under 148, he has to follow the procedure under 148. What is the procedure under 148? Capital A, first let's understand. There is a three-way process. At every process, the assessing officer has to take an approval of specified authority and then move ahead. So before, if he has any material which suggests that the income chargeable to tax has escape assessment, he has to put first before the specified authority for taking an approval to conduct an inquiry. So he will conduct an inquiry based on that information. After conducting an inquiry, if he still feels that I need not issue 148, matter is over. But if he feels no, the 148 notice should be issued, he should grant an opportunity of hearing to AO. So before issuance of 148, he will grant us an opportunity. When this opportunity would be subject to prior approval of specified authority. Once this opportunity is granted, I may give my reply, assessee will give us reply, and after considering my reply, and after taking the approval of specified authority, he has to pass an order. So he may pass an order to drop the proceedings under 148 after following this procedure, or he may issue a notice under section 148. So that's fine. So it's a three-way process, quite a good inbuilt check. That he conducts an inquiry first, he gives me an opportunity, I give a reply, and then he passes a speaking order, and thereafter he issues a notice under 148. So it's quite, and at every stage there is a approval of specified authority. When we go to the approval of specified, it's a minimum level of commissioner. So there is a change in 147 and 148 provisions. What does the 148 provision says? Now, if you remember, the search proceedings have been in case of search, the assessments were happening under provisions of 153 and 153C. Now, any search after 1st April 21, only provisions of section 148 will apply. There is exception to 148A procedure, according to which in case of search or in case of requisition, he need not follow the procedure under 148 capital A. So he has to reopen for the 3 years in case it is the transactions have been recorded in accordance with risk management strategy or any final objection raised by the CAG. So if the information will be deemed to be in case of search and requisition, there is no question of recording that the income is suggest there is an escapement of income. It would be deemed in case it falls under information flagged with the risk management strategy. What is risk management strategy is not known to us. Assessee department has not opened up. It's not within my knowledge as of now. Any final objection raised by say so, in such cases it would be treated as deemed provision. So this safeguard of 148 is not available in case of search. In case of survey, this safeguard is still available because the assessing officer, even pursuant to survey, if he wants to reopen the case for the previous years, he can do it under 148 capital. Now, this is a very important point. Now, let's take in case of survey, what was happening is he could not have opened for 3 years. Only on the basis of survey. In case of survey, the assessments of the year in which the survey takes place was being done, and he used to assess in that year. Whatever was found was presumed to be the income of the year in which the survey has taken place. Now he can open for 3 years under the survey after recording if it suggests that the income has escaped assessments. Now, time limit which was available for reopening was 4 years and 6 years, and in certain exceptional cases, 16 years where the foreign assets were involved. Now this 4 to 6 years has been reduced from 4 to 3 years has gone from 3 to 10 years technically. How? In case of non-serious tax evasions, it has been reduced to 3 years technically from 6 to 3. This applies to search also. In case of serious tax evasions, it has been increased from, technically it has gone up to 10 years. So I would say it has increased from 6 to 10. This was available under the search on the same conditions. Now is available for in all cases that if the income escapement is more than 50 lakhs for the particular year, then it can be extended 2 years. Now there is an embargo in this which says that income represented in form of asset. Please mind it. The similar wordings were in case of search under 153A, where the extended period of 6 to 10 years could be invoked. A similar wordings were there, wherein it was held that income chargeable to tax, which is escape assessment, is in form of asset. So there has to be an unexpended asset, unexpended investment. It should be in the form of asset. If let's take an example, there is an unexpended expenditure, मेरा marriage किया मैंने 5 साल पहले. So whether the extended period of 3 to 10 will invoke, according to me, it cannot be, because that income which has been found even at the time of search or without search also, that income is not represented in form of any asset. That income is already expended. So the serious, it will not fall under serious tax evasion. But if there is any asset created and which is found and the money is involved is more than 50 lakhs per year, then 3 to 10 years will be extended. So sanction, as I said, specified authority is now commissioner up to 3 years, commissioner and rank of commissioners, and above 3 years it's principal chief commissioner. Initially it was joint commissioners and below there were various other sets, but now it has been done. So it's quite a good, because quite a higher authority has been incorporated in this matter. So it's a good welcome move. Satisfied, which was required under the erstwhile provision of 148, has now been replaced by words approval. Initially, the sanctioning authority has to be satisfied. Now it has been replaced by approval. There would be an issue. A new plethora of litigations will start. Whether the satisfaction is more severe than approval. Approval is just a signature, whereas satisfaction was much more than the approval, because there are various judgments which says that the satisfaction has to be with application of mind. It has to be objective. There cannot be just say yes, I approve, something like that. Now, whether words, because satisfaction has been replaced by approve, I'm sure department is under impression approval means only a signature. But I think so it should not be that. Approval should be also similar to a satisfaction. This is a comparison chart between the existing and amended procedure. So what is the important difference between existing and amended procedure? If you see the in between column, what has been deleted and what has been retained. Existing procedure, there was a reason to believe. So reasons were being recorded. There's no reasons now. Obviously now he will record it through passing a speaking order under 148A. So it technically replaces. Then in case of more than 3 years, the reason should show that there was failure on part of assessing. There's no requirement as such now to show that failure on part. So that has gone. Foreign assets which were up to 16 years now will also come under only up to 10 years. The existing continue under, according to me, the new, the existing questions which will be raised in regard to reopening will continue under the new procedure. Change of opinion. Change of opinion according to me can still not be permitted. Income escaping assessment. Jurisdictional question of jurisdiction. He cannot seek reopening for verification. So there has to be suggestion of income chargeable to tax. So he cannot do it for making fishing and roving inquiries according to me. Recording of reasons have in form of passing the order. So recording of reasons have gone, but he has to pass an order. So obviously those reasons will come in that account. Approval of specified authorities, application of mind and procedure. So this will continue. Now, what is an issue that has come? I've been issuing. Lot of notices have been issued after 1st April 21. Now, this Finance Act 2021 has come into force from 28 March 21 when passed. These provisions of reopening are in place already. So technically, there is a one view which is going on, stating that the notices which have been issued after 1st April 21 should have followed the procedure under 148 capital A, that is conduct an inquiry, give an opportunity and then do it. Otherwise, those notices are non-est. They are not valid notices. Now, there is a view. Now, before we, because this is low, there is also another question been asked that since after 1st April 21, the time limit of reopening has changed from 3 to 10 years. What will be the impact on the assessments which were already completed. Now let's take assessment year 16-17. Now you have issued notices for assessment year 15-16. During the assessment year 15-16, the time limit available was 6 years. So whether he can still open it up to assessment year March 22, that question is there. For answering that question, there are two important Supreme Court judgments. One is the old 60 ICAI 262 Karim Tharuvi Tea Estate, and another is Sri Chaudhary Transport Company. What does Karim Tharuvi Tea Estate says is, now it is well settled that Income Tax Act as it stands amended on 1st day of April of any financial year must apply to the assessments of that year. So not the assessments of previous year, of that year. Any amendments in the act which come into force after the 1st day of April of financial year would not apply to assessment for that year, even if the assessment is actually made after the amendments come into the force. So though the assessments are made after the amendments are being made, according to that law which stood at that particular point will be applicable. Similarly, Sri Chaudhary Transport Company says this was issued in relation to 40A1A. Now 40A1A came to statute in 2004. Because 2004 was an election year, budget was passed in September 2004, and it was applicable for whole of financial year 4-5, assessment year 5-6. So it was challenged in this case. Supreme Court said, sorry, it would be applicable for assessment year 5-6. Though the budget was passed in September, when the 6 months were already elapsed, and I had already conducted a lot of transactions. So when I was not aware of the provisions of 40A1A, still it would be applicable for the whole assessment. It relied upon this current Tea Estate. So though the law has been passed on 28 March 21, it is applicable for financial year 2021. The question will arise, it is applicable, though you got only 2 days. All the transactions have already taken place, it will still apply according to me based on Sri Chaudhary transfer. Question that arises is in regard to procedural provisions. Though that means for the assessment year 15, 16, 16, 17, the 6 years time limit, 4 years time limit, the old law as it stood for that assessment year will be applicable if these judgments are to be followed. But it cannot go beyond 10 years, which have been already elapsed now, because now the time has extended from 3 to 10 years. Earlier it was 6 years. So the assessment year 12, 13, which have been already elapsed now and now come within 10 years period cannot be reopened, because there is a clarification already given in the 149 itself to that extent. That's fine. So to resolve the issue. Now the question arises, what happens to the procedural provisions? Whether these ratios can be also applied to the procedural provisions. This is a disputed issue. 2 views are there. Of lately, last week, there is a judgment of Bombay High Court. There's not a judgment. It's only admission of appeal and staying of the proceedings. So you cannot rely upon that. But in this case, because the notice was issued on 7th April 2021 under section 148 for assessment year 13-14. So 13-14 issue ho raha hai. 6 saal baki tha iske liye. So that has not been challenged, right? Because actually March 14 assessment year March 20 को complete हो गया था, लेकिन कोविड के वजह से 30 June तक extended है. So that's why 13-14 was within time limit. They have not challenged that, but they challenged that the procedure under 148A should have been followed, because that procedure has become effective from 28 March, that is 1st April 2021. What Bombay High Court has admitted this case and stayed the notice. That means no reassessment proceedings will take place till the final decision has been taken. So this is, I'm just giving you a feel. We'll have to wait and watch what will happen, whether this will be upheld, that all such notices are invalid, because lock, stock, barrel notices have been issued. Let's presume that Bombay High Court says that this notice is invalid because 148A procedure should have been followed after 1st April. It's a procedural provisions. I don't know. We'll have to wait and watch what will happen. There are 2 judgments which will be relied upon by the department, so there would be a big fight. But at the level of mind, at the assessing office level today, my suggestion would be, please do take objections today itself that you have not followed a procedure under 148 capital A and notice is invalid. We should keep it on record and keep it pending. That's what we can do. Another amendment 2061H. Now 194Q has been inserted from 1st July 2021, wherein TDS has to be deducted if the buyer of the goods purchase more than 50 lakhs from one particular seller and his turnover is more than 10 crores. 206C1H was introduced last year for collection in such transaction where my turnover, seller's turnover is 10 crores more than. So those are the dual now. Now there is already a provision in 206C1. 194Q5 says that this would be applicable irrespective of 206C1H. There is no savings. There is a savings for other provisions of 206C, but not this provision. But there is already a provision in 206C1H which says if the TDS has been deducted under any of the provisions, you need not apply. So now if the TDS is deducted by buyer, you need not collect tax. If TDS is not deducted by buyer, you have to collect. So ये काम आ गया आपके पास. पहले डिक्लेरेशन दो. आपको क्या पता कि बायर डिडक्ट करेगा कि नहीं करेगा. उसका टर्नओवर 10 crores नहीं है. His turnover, if you see my example scenario, what if his turnover is 6 crores, he will not deduct. Then I have to collect tax. If his turnover is 12 crores, he will deduct. I am not to collect tax. If his turnover is 12 crores, in the third example, yes. So now I will have to ask all my SSC to take a declaration from the buyer first, whether when I am selling the goods, whether you would be deducting TDS and 194Q. In those cases, of course, the limit is 50 lakhs. In excess of 50 lakhs only, this is applicable. But the question will arise. So this issue remains. You will have to, the procedural provisions have increased. You have to take a declaration that अगर वो TDS काटता है तो मैं नहीं collect करूँगा, वो नहीं काटता तो मेरी liability है. Of course, my liability is on receipt, whether TDS deduction is on the credit itself. So he will have to deduct TDS first only. At the time when the goods are received or the bills are received and amounts is credited to my account, to the seller's account. So he will have to deduct. So if he does not deduct, and we can also confirm from him at that moment of time. And when he receives the amount, at that time we'll have to take a call whether the amount has been deducted. This is a procedure. The corporate tax rates in India are a small issue according to me, but much relevant still today. You know, if I have an option to go for 22% tax rate, that is, this all rates are including surcharge education cess. If I am not opting for 22%, I have a two tax rates today also, 25% and 30%. 30% is in a normal course and 25% is for the companies whose domestic turnover for financial year 17-18 was for that. I'm relevant. This is for assessment year 21-22 for which I am filing the return this year. अब ये बोलता है फाइनेंशियल ईयर 17-18 में अगर 400 करोड़ का आपका टर्नओवर से कम हो तो आपको 25% से टैक्स कैलकुलेट करना है, 30% से नहीं करना है. क्यों? आपने ऑप्शन, आई एम प्रिज्यूमिंग यू हैव नॉट एक्सरसाइज्ड ऑप्शन. नाउ इशू अराइजेस, दिस कंपनी वाज नॉट incorporated in 17-18. It is incorporated after 17-18. Previous year exceeds 400. So now I have to answer the question that whether the turnover in part A, ITR 6 mein, whether turnover gross receipts in the previous year 17-18 exceeds 400 crore. I have to answer yes, no, applicable for. How would I answer if the company was not included? Would I answer no or would I answer yes? According to me, the best is if the company was not included, that means your turnover was nil. You should answer it did not exceed it, and therefore 25% would be calculated. But this issue, because there's no clarity on this. 222E deemed dividend is become very important. It is applicable when any loan or company is given to a shareholder, when more shareholder is holding more than 10%, or to any other concern where the shareholder is having a substantial interest more than 20%, or for payment for any individual benefit of the shareholders. So this deemed dividend, it is important because you have to report in tax audit. Please note. Now the question arises how to calculate deemed dividend to report in the tax audit. I am a tax audit of a company who has given a loan to its shareholder. Technically, deemed dividend is taxable in the hands of shareholder. So what should I report in tax audit? According to me, you have to report over here, though it may not be taxable in the hands of the shareholder. So you have to give complete details whether such transactions are there. As we know, there is an exception that it does not apply to business or trade transactions. It applies to only a loan or company to a shareholder. There is also a judgment which says that this loan ICD does not apply. Now the issue here arises is how you calculate accumulated profits, because when you want to report how much would be deemed dividend, dividend would be treated only to the extent of distribution or loan given, or there is no distribution, loan or advance given which is in excess of accumulated profit. So for the calculation of accumulated, question arises, it should be on the day of when the loan is given, or it should be an opening balance. How to identify to which shareholders it has been given. How to be distributed, because there may be two common shareholders. If I give a loan from one company to a partnership firm, or दो partner है, दोनों मेरे shareholder 20-10 का है, तो कैसे divide करें? This are that. Accumulated profits पे inclusion or exclusions पे judgment है, which can be of your help, which says that accumulated profits should be as per the books, not as per the computation. Commercial profits, profit earned under 41(2) जो write backs होते हैं, उसको आपको consider नहीं करना चाहिए, ये Supreme Court बोलता है. Then share premium should be excluded from accumulated profits because it's not a freely distributed, it's not a profit. Amount treated as deemed dividend in past. So अगर आप assessment year 19-20 में कुछ deemed dividend के लिए already report कर चुके हो, certain let's take 2 lakhs का loan दिया और मेरा accumulated profits 4 lakhs था. So obviously taxable पूरा हो जाएगा 2 lakhs. Next year में मैंने 5 लाख का loan दिया. या 4 lakhs का loan दिया. You will not again compare with 4 lakhs because 2 lakhs have been already offered to tax. So out of 4 memorandum, you will work out 4 minus 2. So balance is only 2. Now you are getting loan of 5. But the distribution would be only up to the extent of accumulated profit. So only 2 would be taxable, 3 will not be taxable. So this working needs to be done. In whose hands it will be taxable, whether registered shareholder or beneficial shareholder. So if your shareholder is HUF, shares will be issued in the name of Karta. If the shareholder is a partnership from beneficially, but registered shareholder would be individual. So how would you tax? The Supreme Court says in case of HUF, it should be taxed in the hands of beneficial shareholder. So registered shareholder may say, I will not. Of course, initially, पहले problem होती थी कि registered shareholder और beneficial shareholder अगर different होता, there was no mechanism for a company to know. But now there is, according to me, there is a filing under Companies Act wherein the beneficial shareholder has to be declared. So the company will know in whose that it will be taxable. Now the question may arise, if there is a deemed dividend transactions reported in tax audit, whether I should deduct TDS on that, though there is no dividend distributed. Dividend is not distributed. I have given advance. It has been treated as deemed dividend under 222 and tax has been levied on the shareholders end. But I have no. So because the TDS is on distribution, dividend declared, distributed. I have not declared, I have not distributed. It is under the deeming provision. So according to me, TDS should not be made applicable. But this issue will remain. There would be a fight. Then how you would tax it in the hands of different shareholders? I'm an auditor of a shareholder who is an individual as well as a proprietary concern. I receive an advance and another shareholder also receive advance. दोनों ने 2 lakh रुपया tax हुआ, but only 2 lakhs is an accumulated profit. So tax would be only restricted to 2 lakhs. So how would I divide? According to me, it should be a proportionate basis, which has been accepted by various judgments as listed in this regard, which can be referred in my slides. Intercorporate deposits are not covered by oil districts. Advances made in ordinary course of business, the various judgments again. Transaction in nature of current account transactions, मैंने उनके behalf पे tax pay किया, reimbursement आया, should not be covered. These are the judgments which will help you. 14A, of course, it is not much relevant because now dividend is taxable, capital gains is taxable. It is not relevant much, but still tax auditor has to report. So let's take an example. I'm a partner in a firm and I'm receiving a profit share from firm which is exempt. So obviously for earning that exempt income, you should not claim any expenditure. So you still, it will be applicable to that extent. But a lot of litigations will come down once dividend has become taxable and this. So there is no exempt income as well. Most of litigations revolved around dividend and long-term capital gains. It will be reduced. But the satisfaction of assessing officer is must. So if you are reporting nil, there's no duty on you to report 8D. If assessing officer has to get satisfied, Bombay High Court says, and that after satisfaction is not satisfied, then he has to refer to 8D. He has to go to 14A subclause 2. No disallowance of interest where sufficient own funds are available. So there are various Bombay High Court judgments which says that I have a borrowed funds and also own funds, and if I've invested into a non-interest bearing or exempt income available, then the presumption should be drawn that my own funds have been utilized to make an exempt investment. So this presumption is there. Net interest to be considered, interest income earned less expenses should be considered for the purpose of 8D. Where you have not received any exempt income from particular investment, that should not be considered for the purpose of Rule 8D. Because it has to be restricted to exempt income. These are the various judgments which says no disallowance can be made if no exempt income is earned disallowance. So 40 days more or less settled. This is another provision which was came in assessment year 19, conversion of stock in trade to capital asset. आपको पता है अगर capital asset से हम stock in trade में करते हैं तो आपको tax benefit होता है कि you may pay capital gains and on the fair market value on the date of you pay tax later on when you actually sell the asset, but up to the fair market value you will pay capital gains any on the date of conversion, and above that you have to pay business income. इसमें conversion of stock in trade into capital asset 28(6)(a) बोलता है कि as soon as you convert from stock in trade to capital asset, it will be paid on accrued basis. So आप खाली conversion कर रहे, you are not selling that asset, but on that notional income it has to be paid. Now this is against the real income theory which has been upheld by various laws that only real income can be taxed, no additional income. So if I'm converting a stock in trade to capital asset, I'm making a book entry whether tax should be paid. 28(6)(a) says yes, it should be paid. So you need to plan their affairs, though this is against the real income theory and may be litigated at various stages. Then there are small which I'll just slide down in next 5 minutes in regard to 37(1) expenses. before I close up. Allowability of CSR expenditure. Explanation डाल दिया है 37(1) में कि अगर आप CSR expenditure जो 135(2) of Companies Act में claim करते हो तो वो आपको allow नहीं होगा. Question arises, मैंने किसी institution को donation दिया है और CSR में Companies Act में claim करता हूँ, क्या मुझे ATG नहीं मिलेगा? There are two views. A lot of people are not claiming ATG. Please believe me. My view is you should be available. The explanation only applies to 37(1). So if you are claiming any expenditure under 37(1), which is otherwise claimed under CSR, taken as a benefit under CSR of the Companies Act of Section 135, then it wouldn't be allowed. Other expenses incurred under any other heads which is otherwise allowable. Deductions allowable under ATG, 35(2)(ab) donations allowed, will be allowable, irrespective it has been taken a benefit under CSR. That's my view. Now there is a judgment of GNVFCL, Gujarat Narmada, wherein though this is prior to this explanation was inserted, it says the CSR expenses should be allowable. It's in relation to 37(1). Now this judgment is not an important from a point of view. You have to see if claimed as CSR under Companies Act, तो आपको disallow 37(1) में होगा, लेकिन other heads में मिलेगा. If it is not claimed under CSR under Companies Act, 135 में मैंने feel नहीं लिया. If you read the explanation, it only restricts which is claimed under 135. If you have not claimed, you will still be allowed. This judgment will come to your rescue. Legal expenses incurred to protect directors and shareholders in their individual capacity is not allowable. Please find it. काफी जन करते हैं director shareholders के personal expenses, directors company pay करती है. It will not be allowable. Advance license, DPP, we do it on accrual basis. Our AS9 says if the certainty is there that you will receive advance license, you have received advance license DPP, and there is a certainty that it will be utilized or it will be sold in the market, you should book it AS9. Now, this judgment of Excel Industries in Supreme Court says that till the time the value involved, amount of duty involved in advance license or DPP, benefit involved, will not be taxed till the time actual benefit is utilized by doing an import or by selling it. So you can take a view, there can be an AS9 accrual. I'm not going into provisions of AS9, but the question is, by taking the benefit of this section, whether I can postpone my tax liability. Can I add back the accrual basis in my books? Could be done because it's an hypothetical income. You have not received it. When I actually utilize this advance license or DP, I can pay tax. Commissions and bonus 36(1)(2) says that any commission and bonus paid to shareholders and directors, which was otherwise payable as dividend, should be taxed. So generally in private companies, we see dividend तो declare करते ही नहीं है सालों साल और खाली commission और bonus pay कर सकते हैं. दलाल ब्रोचा का एक judgment है जहाँ पे factually उन्होंने dividend नहीं दिया था और सिर्फ 2 ही shareholder है और 2 ही director उन्हीं को खाली commissions दिए. तो उसने disallow किया 36(1)(2). You have to keep in this mind that there should be such a scenario wherein nothing is being paid to other employees, only shareholders and directors are paid. These are nothing but in lieu of dividend. So 36(1)(2), there is an obligation on auditor also to report it. Please keep it in mind. So this judgment should be referred for this purpose. Bad debts written off. Generally, आपको पता है, we are not writing a provision for doubtful debts has not been allowed. That is the general tendency. Nobody's, it's adding back to the income. आप provision करते हो. Question ये है कि provision को, if you see our Companies Act or any other books also, generally we reduce provision from sundry debtors account. The question arises when I'm मेरे balance sheet में, मेरे presentation में debtors को मैं net बता रहा हूँ. Sundry debtors gross less provision for doubtful debt. भले books में मैंने accounts को zero नहीं किया by doing a write-off. Can I still claim a write-off? According to me, it can be claimed. You can rely upon the Supreme Court judgment of Vijaya Bank which says, since assessee has made a provision for bad debts by debiting P&L, said provision was deducted from debtor's account on a control, not an individual. Similarly, in case of loans and since once the netting is done, it should be allowed. So provision can be claimed according to me. You can claim it. Though we are disallowing it and you are claiming only when actual write-off happens in the books. But if you see technically in the balance sheet, there is a write-off. What you are doing is writing it off. Sundry debtors minus provision. So it's a write-off. The last point of 56(2)(7)(b), 56(2)(10), 56 में rule 11U UA होता है. Startup companies are facing a problem. You do evaluations and the valuations are being not accepted because the projections are not achieved. So I thought I will bring it this issue. The valuations are being challenged day in day out. आपको जब भी share premium high आता है, तो assessing officer wants to tax it under section 56(2)(10), 56(2)(7)(b) as well. So he wants to tax it. So this will give you a brief background. Can the technical assessee has a power to challenge the valuation report? According to me, no. Since an entertainment Delhi ICAI, it supports that. So he cannot. Even if the projections are not achieved, it cannot. There are judgments to the tribunal because the valuation report assessing officer cannot challenge. He does not know how to do the valuation. He's not a competent authority. And valuation done by a competent authority prescribed by the law cannot be challenged unless it is completely fraudulent. So that cannot be challenged. Even if they are unrealistic, even if it is made to comply with the bank lending, it cannot be. If the shares are being interchanged among the family and there is only a benefit or price difference only affects between the family members, it should not apply, Bani Estate says, because ultimately transaction between related parties anyways exempted under the gift. Whether exempted entities or transaction 57 can be brought to under 56 months. क्या हो रहा है sir? This transaction 56(2)(7) exempts non-resident investment from NRI and venture capital. But assessing officer is now trying to tax this under section 56 months. There are a lot of assessments which are open on this count. 56(2)(7) does not apply to you. 10 does not apply to you. 56(2)(10). But 56(1) में मैं main provision में tax करूँगा income from other sources. So this judgments can be upheld, which says the transaction which is otherwise taxable under the other head, and there is an exemption granted in the specific transaction, it cannot be brought into tax under the general provisions. Buyback of shares is not covered. 56(2)(7) does not apply. Similarly, rights issue does not apply because there is no benefit or gain which is arising inter se amongst the shareholders. Buyback is offered to everybody. Rights issue is offered to everybody. It's their choice to subscribe or not choice. So there is no inter se rights which are been affected, and therefore it's not applicable. This is a method. I'll leave it up to you. And thank you very much. So I tried to cover the whatever issues which I felt would be an important, which will be relevant for this year's assessments, for this year written filing. And that's how I've tried to cover up. We have next 5 to 10 minutes if we can take any questions on this. Thank you. Thank you very much, everybody. Thank you for your patience here. I think so. There are some questions. Ritu, should I take it from chat box?
Yes, sir. Members can post their queries in the chat box, please.
Sir, the extension of time limits for appeal shall be applicable in case of IT 82 also. Yes, it will be applicable because there's a Supreme Court judgment which says that all time limits have been extended. So there is no specific provision for appeal, but there's a Supreme Court judgment which says all time limits have been extended. Now it's पहले उस judgment को 15 March तक close कर दिया था कि अब after 15 March whatever pending days are there, you have to file an IT appeal or any other appeal. Now it has been again extended that there's 15 March till the new date comes in. So it is all from last March till now. Today it's an extension going on. That's all I think. So there's only one query. If any other queries are there, we can take it. Otherwise, we are done. Ritu, there's only I've completed that.
Sir, anybody is posted, no. Members, if you have you received any query? No?
Ritu ma'am, there are no other queries. You can proceed ahead.
Okay, okay. Okay, sir. So it's a fantastic session and indeed a knowledgeable session with very well explanations to the sections. I'm sure our participants are very much enthralled with your presence, and I request CA Kishore Mehta to give formal vote of thanks to our today's speaker.
Am I audible, Ritu?
Yes, you are.
Yes. Yeah, thank you, Ritu, for giving me an opportunity for proposing vote of thanks to our speaker, Piyush Chhajed. I, CA Kishore Mehta, on the behalf of the Bhayander CP Study Cycle of WIRC of ICAI, will take privilege and honor to propose vote of thanks to our multifaceted and multi-talented speaker, Piyush Chhajed, who have explained the important issues in direct tax which arose due to amendment to Finance Act 2021 with practical exposure and examples. Indeed, our speaker explanations were very relevant and apt for us to fulfill and enrich ourselves with the knowledge. I'm sure that our participants had a lot of takeaways from today's VCM. I also thank to each and every participant for making this VCM resounding success. Thank you, sir. Thank you very much.
Thank you very much.
Thank you so much, sir, for coming to our study circle. Thank
Thank
you.
you,
Sir.
Ritu. Thank you, Shiv. Thank you, Kishore.
Thank
Sir,
you, sir.
request you please share the PPT.
Yes, I'll share.
We can circulate.
I'll share with you.
Thank you. Thank you, sir.
Thank you, sir. Thank you very much.